Many new investors, and even seasoned ones for that matter, will make the mistake of thinking that long-term investing should be thrilling, with buys and sells taking place on a daily basis. This isn't the case. In fact, a recent study showed that passive investors who buy an S&P 500 mutual fund instead of an S&P 500 exchange-traded fund will make greater returns over the long term than their ETF counterparts. Why is that? They both own the same asset, just in a different vehicle type. Here's what's going on. Mutual funds settle their trades at the end of the day, and ETFs trade during market hours. So investors who choose a mutual fund are less likely to overtrade than those who pick the ETF. ETF investors are more likely to be tempted to buy or sell during market hours, thinking that they can make profits before an impending sell-off or add more to their position before a perceived rally. Success in investing often comes down to a single idea. Investing should be boring. If you're a typical investor and not a crazy person like me who spends 60 to 80 hours each week doing this, you might have 5 to 10 positions in your portfolio. In fact, most experts don't recommend you have more than 10, as it will take too much time to stay informed for most investors. With less than 10 positions, you most likely won't make a move in your portfolio each week. In fact, you may not make a move in your portfolio for months. There's absolutely nothing wrong with being an active investor, but it's always worth remembering the adage. It's not timing the markets, but time in the markets that matters.